Welcome to Global Economic Brief, where we analyze the turbulent financial tides to help you navigate these uncertain economic waters safely. Today we investigate the dramatic volatility in silver, witnessing a crash to $71 followed by a sudden 17% rebound. This unexpected recovery during the overnight session has left traders wondering if we have seen the bottom or just a trap. The market sentiment is currently extremely fragile, with investors trying to decipher whether this volatility signals an opportunity or a warning. To understand this silver crash, we must look at Bitcoin, which has acted as a leading indicator for global risk sentiment. When Bitcoin closed below $82,000, it triggered a massive wave of selling pressure that quickly spilled over into metals. This technical breakdown in the crypto market acted as a catalyst, forcing algorithms to liquidate positions across the entire commodities sector. The correlation between these assets proves that liquidity is being drained from the system, causing sharp corrections in almost every market. We witnessed what many experts are calling a flash crash, a rapid decline designed to trigger stop-loss orders from retail traders. Many analysts believe this move was not natural but a calculated maneuver to shake out weak hands before the next rally. As the sun rose over London, the initial panic subsided, and buyers stepped in to defend the critical support levels aggressively. The price stabilized around $83, creating a temporary floor that has given bulls a glimmer of hope for today. However, to truly understand this market, we must distinguish between the paper derivative market and the actual physical silver market reality. A shocking disparity has emerged between the West and the East, with Chinese markets trading silver at nearly double the price. Data from major Chinese retailers like JD.com shows silver changing hands at $163 per ounce right now. This represents a premium of 95%, a historic anomaly that suggests the Western paper price is completely detached from reality. Usually, arbitrage traders would close this gap, but physical restrictions and supply shortages are preventing the market from normalizing efficiently. Investors holding physical silver know that the paper price on the COMEX is merely a distraction from the true value. Reports are coming in from Singapore, Australia, and Hong Kong indicating that physical silver is becoming increasingly difficult to acquire globally. In Singapore, we are seeing long queues forming outside bullion dealers as smart money rushes to secure physical assets immediately. Dealers in Hong Kong have reported being completely sold out of silver bars, leaving many investors empty-handed despite their willingness to pay. This physical scarcity is the ultimate fundamental support for silver, regardless of how much the paper market tries to suppress prices. The paper market is driven by leverage and speculation, allowing prices to be manipulated downward even when real demand is skyrocketing. The drop to $71 likely triggered margin calls for over-leveraged traders, forcing them to sell at the worst possible moment. When margin calls hit, logic goes out the window, and assets are sold indiscriminately to cover losses in other portfolio positions. Algorithmic trading exacerbated the move, detecting weakness and piling on short positions to drive the price down further and faster. Yet, the 95% premium in China remains the elephant in the room that Western analysts are struggling to explain away. This price gap suggests a decoupling of Eastern and Western markets, where the East values physical assets far higher than the West. China is absorbing physical silver at an unprecedented rate, using the lower Western prices to drain global vaults of inventory. We are witnessing a historic wealth transfer, where physical commodities are moving from West to East at bargain basement paper prices. Is this crash a bear trap designed to scare retail investors out of their positions before the next major leg up? The sharp V-shaped recovery suggests strong institutional buying interest the moment prices dipped into the low 70s during the session. Smart money does not panic during flash crashes. Instead, they use these liquidity events to accumulate massive positions at discounted rates. All eyes are now turning to the New York session, which will determine whether this recovery can sustain its momentum today. We are looking at two distinct scenarios for the coming hours: a battle between the bears and the bulls for control. In the bearish scenario, the selling pressure resumes as U.S. traders wake up to margin calls and forced liquidation orders. If the $82 support fails, we could see a retest of $71, flushing out the remaining leverage in the system. A break below the recent low would be catastrophic for short-term holders. likely triggering a cascade of stop losses across the board. Conversely, the bullish scenario sees the $83 level holding firm, acting as a springboard for a rapid price recovery. If buyers can defend this level, we could see a swift return to $87 or even $90 within days. The market is currently like a coiled spring. The deeper the suppression, the more explosive the eventual breakout will inevitably be. Macroeconomic factors such as inflation and currency instability continue to provide a long-term tailwind for precious metals despite short-term noise. Silver remains a hedge against the systematic devaluation of fiat currencies, a fact that long-term investors are keeping in mind. Industrial demand from the green energy sector ensures that the physical floor for silver prices remains higher than paper traders realize. Unlike gold, silver is consumed by industry, meaning that once it is used in electronics, it is often gone forever. COMEX inventories have been bleeding silver for months, creating a precarious situation where paper claims vastly outnumber available physical bars. We are approaching a perfect storm where industrial shortage meets monetary demand, creating the potential for a massive short squeeze. For the rest of today, watch the charts closely on the 4-hour timeframe to see if higher lows are established. Indecision candles on the chart suggest that the market is taking a breath before deciding on the next major direction. Volume will be the key indicator. We need to see increasing volume on upward moves to confirm a true reversal. Be prepared for extreme volatility in the coming days as the market tries to find equilibrium between paper and physical. Holding positions in this environment requires nerves of steel and a clear understanding of the long-term fundamental drivers at play. Remember the 3 key factors: Bitcoin's risk signal, the massive China price premium, and the undeniable global physical silver shortage. These factors combined suggest that while the short term is rocky, the long-term potential for silver remains incredibly potent. History has shown that when the disconnect between paper and physical becomes too wide, the physical price always wins eventually. If you found this analysis helpful, please like this video and subscribe to our channel to stay ahead of the curve. We will continue to monitor these developments around the clock, bringing you the most critical updates as they happen live. Keep your eyes on the charts and your focus on the fundamentals, as the next few days will be decisive. Whether you are a trader or a long-term stacker, understanding these market mechanics is essential for protecting your hard-earned wealth. The sun may be setting on the old financial system, but new opportunities are rising for those who are prepared. We believe that eventually, true price discovery will return to the silver market, rewarding those who understood the real value. Market forces are like a river. You can dam them up for a while, but eventually, the water breaks through. Time is ticking for the paper shorts, and every ounce of physical silver removed from the market accelerates their demise. Document this moment in your trading journal, as we are living through one of the most fascinating periods in financial history. As fiat currencies across the globe continue to weaken, the allure of hard assets will only grow stronger and stronger. Mining supply cannot be increased overnight, adding another layer of pressure to the supply side of this complex equation. With energy costs rising, the floor price for mining silver is also increasing, supporting higher prices in the long run. Even our advanced AI models struggle to predict the exact timing of the breakout, but the direction seems mathematically inevitable. Stay connected with the news, but filter out the noise to focus on the signal that matters most to your portfolio. Our channel aims to be your lighthouse in this storm, providing clarity when the waters get rough and visibility is low. Zooming out to the weekly chart helps us maintain perspective and not get shaken out by intraday volatility and manipulation. The journey to the top is never a straight line. It is filled with valleys and peaks that test your conviction. For those looking to enter, patience is key. Wait for the market to come to your price rather than chasing. Preservation of capital should always be your primary goal, with profit appreciation being the secondary benefit of holding precious metals. Ignore the conflicting opinions of mainstream media pundits who often do not understand the mechanics of the physical metal market. History repeats itself. And we are following a script that has played out many times before in previous economic cycles. The current setup bears a striking resemblance to the 1970s, where commodities outperformed stocks and bonds by a massive margin. If this pattern holds true, silver is currently sitting on the launchpad, fueling up for a move that could shock everyone. Our team is working tirelessly to analyze every data point so you don't have to navigate this complex market alone. The convergence of digital assets and physical commodities may define the next era of our global financial system's evolution. What will happen next? Only time will tell, but the signs are pointing towards a significant shift in market dynamics. We hope this breakdown has given you a clearer picture of why silver is behaving so erratically right now. Use this information as a compass to guide your decisions, keeping emotion out of your strategy and focusing on logic. Reviewing the dashboard, the divergence between price and value has never been wider, offering a unique opportunity for astute investors. Patience is a virtue in investing. Allow your thesis to play out and give the market time to correct itself. Nurture your portfolio with knowledge and protect it with risk management, and you will weather any storm the market brings. Once again, be careful of leverage in this environment, as the volatility can wipe out accounts in the blink of an eye. After every storm comes the calm, and for silver investors, that calm may come with much higher price levels attached. This has been a special report from Global Economic Brief, dedicated to uncovering the truth behind the numbers on your screen. Please leave a comment below with your thoughts. Do you think silver has bottomed? Or is there more pain ahead? Thank you for watching Global Economic Brief. Subscribe now for more deep dives into the shifting sands of the global economy.